Good afternoon, everyone, and good afternoon, panelists. So this is a very interesting session for me. When I started my career, there used to be one single fund, then the Nifty B it used to be called. And it was a 40, 30 crore kind of corpus, right? That was the size of the fund way back in 2003-4. And there it used to be, just one, niche strategy we used to use just when we were trading for high net worth investors, just a place to park money. From there, it has been a very long journey. So, right, the passive industry has grown manifold. And it's no longer a fringe strategy. It's pretty much a dominant part of at least my clients' portfolios. So, in the last 5-6 years, we've seen this massive growth in passives, almost 10 times the size, right, from 2019-20. What is the driver of this growth? Pesi, you.
Sure. So good afternoon, everyone. And of course, the last 10, 12 years have seen this explosive growth for passives. Today, it constitutes about close to 18% of the mutual fund industry assets. I think there are three things that happened structurally that changed it in the last decade and a little more. First, institutional buying. So we had this, the government body EPFO came in and regulations asked them to invest in equity markets, and they came in through the passives route. Following them, many other similar entities came in. So I think the first thing was institutional buying. The second big progressive step that got implemented was the regulars' attention to this segment, and whether it was market infrastructure, market regulations that allowed and promoted ease of working with passives. The third phase, I think, is digital distribution, and it brought in a wave of new first-time investors, and those people very simply said, I'd like to do it myself. I don't know what I'm supposed to buy. Let me just go and buy a passive. So I think over these three, phases, we've seen this growth happen. And then, of course, there is a much larger advisory community that has looked at passives. But I think if I had to look from back to the future, probably about by 2030, this 17-18% should jump closer to 30 or 32% of the dense industry assets, is my assumption.
Well, I think, already are at around 17 or 18% already. Chintan, to you, this question. What is it that makes it so attractive for institutional investors? Why is it, alpha is not difficult or very difficult in India at least. We're still a market which at least most advisors would believe there is alpha in the managed space. What is it that investors find so attractive about passives?
So, thank you all of you, and thank you ARIA for inviting us, first of all. You went back to 2003-4 and was mentioning only one fund. So when I joined ICICI 2005, when it was called Prudential ICICI, I had no clue about ETFs either. But there was one fund called Sensex ETF, which was called SPICE, all of 68 lakh rupees, and I was the fund manager for that. So I'm going back 20 years. But the industry has grown, of course, and I never knew that experience would help me in 2016. When I became product head, and then we launched 60 funds across index funds and ETFs. So that's there. But I think the supply-demand scenario was such that India was growing. We went from a situation where people were investing directly into equity markets to post-2014 mutual funds active side. Then went from mutual funds active side, that was growing significantly post-2019-20, especially when Aadhaar-linked investments and demat accounts grew from 3 crore to almost 12 crore. We are finding more and more adoption and ease of investing. And then obviously as asset management companies grew, it was not a question of having active or passive, it was active and passive for all asset management companies. So I think the focus which asset management companies also put on the passive side helped create more products. And then of course, this entire community of advisors who made this possible for more and more people to get the access and understanding. It's still in its infancy, because if I have to break down into numbers, index funds about 250 are there in India. ETFs, about 250 are there in India, but to those 250 ETFs, of course, because of the institutional investment, carry about 8 lakh crores. Index funds, 250 of them carry about 2 lakh crores. And then gold and silver, courtesy the last 1 year of boom, are about 2 lakh crores. So it is still top heavy. Top 20 ETFs account for almost 90% or 85% of the AUM. But that's the case it's going to be. And as we see more penetration, more understanding, and more importantly, as we go along, we'll speak about how we can construct portfolios through ETFs. More and more people will be able to basically create those baskets, and then the growth will eventually happen. Currently, it's institutions and very few products which have actual meaningful AUM. I'm hoping through these interactions, we're able to expand the horizon of advisors to think how we can create the entire portfolio, because it is with that intent we had created those 60 portfolios of products, and then the entire industry has. And I think S&P in the last maybe 10 years or so, when Koyal used to be there, Koyal Ghosh, we did a lot of interactions with a lot of distribution because of that also. So I think it will grow. The only thing is that we need support from all of you. And from our end, as far as AMCs are concerned, we are doing our best to do it efficiently and at low cost, which is, I think, the core of ETFs. Thank you.
Ben, so you've seen the journey of passives actually across the globe. You know, you have been the architects of Indices across the world. Is the journey in India any different from what you've seen in other countries? Is we are going to chart a different kind of journey because our markets are very different from, say, developed markets like the US?
Yes, absolutely. First of all, it's great to be here. It's an honor. Thanks for inviting me on the panel. But yes, absolutely. Although there are some regional differences, but the fundamental drivers behind the success of passives are in place in India just as much as they are in the US. So what do I mean? First of all, it is much lower cost because there are no need for a big army of analysts and fundamental stock pickers, and that advantage compounds over the decades. So year to year, in a single year, it doesn't make as much of a difference, but over decades, this fee advantage compounds. And another important factor behind the rise of passives have been the fact that long-term returns on the stock market are extremely skewed. So a very small percentage of companies generate pretty much all the wealth on the stock markets. And for a concentrated stock picker, it is very hard to find those few needles in a huge haystacks. And the tendency of owning the whole haystack outperforming the concentrated stock pickers is something that we observed across all geographies. Currently, we cover 11 major regions in the world, including India, and the evidence is quite clear that these fundamental forces are at work. And the third one I would mention, which probably at an earlier stage in India compared to where it is in the West, but the tendencies there is despite significant retail activity still in India, I think the long-term trend is towards the professionalization of the whole industry. And that means that there is less players who professionals can subtract alpha from. Because if you think about it, like in a market as a whole, someone's outperformance by definition have to come from someone else who is underperforming. And as long as there is a big army of retail traders who are not trained, who don't have qualifications, who are not studying markets full time, there is a available pool of people to give up performance in favor of the professionals. And as well, first in the US, but then Western Europe, and judging by the trends, probably moving to India as well. As more and more AUM, like assets in the market, will be concentrated in professionally managed funds, that potential pool of alpha, of outperformance, is actually gonna shrink and is shrinking.
So it's very interesting you said this, because my next question was on market impact, long-term market impact. Because two major impacts that I feel when passives become a very powerful part of assets it's like, you know, a lot of money chasing a group of companies, regardless of valuations, concentration risk happening. You know, both these things we've already seen in the S&P 500, right? We're seeing that 35% of the 500 S&P is now constituted by just 7 companies. That kind of risk in a market that is not as deep in India. So does it bring about any risks? That's one. And the second thing is, ultimately, active fund management is all about price discovery, efficient allocation of capital. If passives is going to drive the entire market, and then that kind of, you know, brings active into a back foot, will we have that type of price discovery? We'll just have a market that's chasing momentum, and that may make it an inefficient market. And we are in a market which is not as deep as the US markets are. Can we look at a market where passives become such a large portion of of assets under management by mutual funds? Chintan, this perhaps you can answer better.
So I think Mr. Market eventually in the long run self-corrects. So if, for example, passives do become very large, then obviously for active it becomes easier to generate alpha. And let's remember, we are in a country where thanks to the growth of almost 6.5–7% on a real GDP basis, and newer sectors getting listed. Think of it, maybe 15 years back, no insurance companies listed, no defense companies listed, very few options across so many sectors. The entire, obviously, the manufacturing space, so many companies getting listed which are making into mobile phones, etc. So newer companies getting listed, there is going to be a mispricing, and that mispricing is what active fund managers will be able to basically gauge and make alpha out of. So in a growing economy, it becomes obviously that much easier to generate alpha, but you have to pick the right fund manager, the right fund, and that becomes a challenge. And that's where most people say, okay, fine, let me not try and bother about the right fund manager, right alpha. I'd basically participate in India's beta, which itself is likely to grow at a significant pace of 11 to 12%, and I'm happy with that. And if I'm getting a diversified pot of 500 stocks, which will do the job for me, it is good. But it's unlikely that, you know, one piece of the market, which is either active or passive, becomes so heavy. Of course, the volatility in India, apart from the last 1.5 months, was very low for the last 6 years because of the activity of continuous buying of, let's say, Nifty or Sensex ETFs, the large caps, through the PF or pension fund assets. That kind of gave stability, and also the retail assets and the SIPs, we can't forget. So this constant pool of $4.5–5 billion of money coming into markets obviously stabilized the markets. So to that extent, there was not much volatility. But in general, volatility is the friend of active fund managers. And as far as a growth economy is concerned, passive will ensure you can participate in beta. Also within passive, you will need the right advisor to tell you whether I should go for a defense index fund today, or I should go for a low vol, or I should go for a momentum. And if you are able to do that, then you can create alpha within that. So the question of alpha is not only about whether a fund manager on the active side is generating alpha, but through the allocation of even passive funds in the right manner, can you as an advisor generate alpha? So maybe throughout the last 2–2.5 years, if I go back, and I tend to do this, go back and see what are the articles that I wrote, what are the interactions in media which I did. Most of the time I was speaking, okay, markets are looking a little expensive, but gold and silver is looking good, right? So gold and silver allocation also through the passive route was one of the ways in which alpha could have been generated. And maybe 1.5 months back, if I look at the 2026 beginning of the year articles or news that I was speaking, I was saying, okay, silver and gold both look stretched. Let's go back to equity. Of course, I did not know the war is coming. So I don't think it's a question of active or passive in terms of growth. What we should, as advisors, do is select the right segment within active and passive, and that will make money. It's no longer active or passive in India, it's both.
But Chintan, all this active, passive shifting means a lot of taxes for my clients, right? So as advisors, we are looking for products that we can just plug and play. That's the need of the market. We don't want to pay taxes. We don't want to do this active churning and management in between whatever smart beta factors are there or whatever. So, Pesi, you had shown us one very nice product, right? Which was a multi-factor product. Yeah. So, you know, where is the industry going in terms of giving us those kind of products where the alpha is coming because of actively managing passives?
So, I think, this evolution is simply wonderful between the product, the manufacturer, and the role of the mixer, that is the advisor. You go back into passives and you started the journey with market cap based or sectoral. Then we got a little more evolved and, to look smart, we called it smart beta, factor based, all of that. I think the next generation will actually go micro rather than becoming more and more macro to give you sleeves, pockets or cuffs of a shirt in an index which you'd like to participate in, okay? So I think from a manufacturer's point of view or the evolution of indices, broad market cap based to factor based to very, very thin, small pockets, okay? And let me give a small example of that. We have a product which is replicates the Nifty Private Bank Index Fund. It's got 10 stocks, 4 stocks constitute 80% of that index, okay? Look at an index in healthcare.
I'm sorry, but who's investing in that?
Oh, you'll be surprised.
Please tell
Me,
us.
myself.
Okay.
Because and I'll come to why, okay? But you take a segment of healthcare, today, healthcare used to all be about pharmaceutical companies. Today it's about hospitals, it's about diagnostics, it's about pharma. And there will be times within a sector, you like a particular pocket more than the sector itself. So the evolution and the journey will keep providing you options. So from being very broad, you will keep coming down, becoming narrow and narrow. Now comes your role. You hate paying taxes, but empirically it's evidence that there is still a lot of churning. So it doesn't, actions and words are not congruent. But having said that, I think the role of the advisor, and very beautifully and meaningfully, will be building a core and building satellites. You'll probably stay very long term in core, and you'll play satellites for absolute returns and not necessarily lifelong love affairs. And for those satellites that present those opportunities, I don't think this market has yet evolved even in that direction. So I think, there is a lot left for the manufacturer to create and for you guys to build into portfolios, strategic and tactical both. And that's the reason why I think, ye to bas shuruaat hai.
Ben, you must be having a lot of innovations happening in the indices space, in the architecture of indices. Please throw some light on what we should expect in the coming years. Is there something, any surprises?
Yes, I would break the innovation happening within S&P Dow Jones Indices into two parts. One relating to the actual creation of indices and a new type of indices, and another one I would call performance measurement or like adjacent areas. So starting with the first area in terms of what's new in indices right now. One area of innovation has been the incorporation of AI and AI methods into index creation. So just at the end of last year, we launched our two indices which already incorporate AI into index design. One is the S&P.
Please explain, what does that mean? You're incorporating AI means, is AI designing the indices, or is it in AI companies?
So of course there's a human oversight in the governance of the indices, but we launched an S&P 500 and S&P world-based index, both of which incorporate AI forecasting for every single constituent of the S&P 500 and the S&P World for the next 12 months expected return based on both bottom-up and top-down forecasts. And in the case of the S&P 500, the AI free, actually it's called S&P free AI 500, top 100 index. So basically, the way it works is that based on this AI forecasting, forecasted returns for the next 12 months, it picks the 100 stocks from the S&P 500 with the greatest forecasted returns for the coming 12 months, and it rebalances annually, and the weighting of the index is proportional to the forecasted returns. So of course, there is very short live performance, but based on the back-tested data, it outperforms the parent index by, I think, about 2% per year. So we are very excited and curious to see how it performs in a live scenario. Another area of innovation is trying to indicize and develop indices for asset classes which have traditionally been very opaque and where no benchmark existed. So one example is the private credit, which have been growing exponentially very fast, but appropriate benchmark was lacking for assessing the performance of individual credit managers. And the third one in the index side, before I briefly move on to the adjacent areas, has been tokenization. So we worked on tokenizing the S&P 500 and some other indices. And very briefly, before I pass on an innovation on the adjacent side, which, if it's coming to India, it would be, I think, very interesting and relevant for ARIA members, is that we just bought, S&P Digest Indices bought a company called ARK Invest, which what they do is that they provide benchmarking for investment advisors like yourself. So obviously the objectives and the constraints for investment advisors are not necessarily exactly one for indices. So what this company does is that it gets contributions from a big pool of investment advisors and wealth managers across various risk buckets, and then it creates benchmarks for all these portfolios in various risk buckets and distributes it to the subscriber. So basically, it's a way for investment advisors and wealth managers to show their clients and benchmark their performance to their peers rather than like an arbitrary single index or a portfolio of indices.
So just 1,000 of us in India. Is it enough for them to come here?
Well, we'll see. Now, this company is mostly caters for European, like UK and European audiences, but who knows what the future brings.
Yes. So again, now that we are talking about innovation, and the next question is, because passives are going to grow the way they are, what are those segments in the market where active will outperform, where we could look at products which are actively managed?
Sure. So I think, first in India, clearly in my mind, I think small cap, mid cap is a space, the information asymmetry is extremely high, and there is enough value and alpha that a manager can bring to the table. That definitely has and very rapidly disappeared as far as large cap investing goes. But I think, in a 5,000 listed company market, if there are just about 400 to 500 that are actively researched, I think that information asymmetry is extremely high, and you will be able to create alpha, one, from the small mid-cap segment. Second, I think nimbleness in active managers will allow for them to be able to act and react much faster, also be more proactive in price discovery. So I think these three things will continue to play out, for some point of time to come in India.
Chintan, what's your view on that?
So I'll take the two questions. One was on the tax, which we spoke earlier, what to do with tax if you have to churn. And of course, under what circumstance, where active will do well, etc. So empirically, since I have been an active fund manager between 2010 and 15, and then when I came on the product side, I launched a lot of passive funds. So obviously, this dichotomy was also in my mind. What I have seen essentially as far as performance is concerned is that when the market is going up, let's say you started investing sometime post-COVID, 2020 to 2024, your passive small cap or micro cap and mid cap is difficult to beat. Meaning the passive or the index funds will do better than the active funds in general in the mid and small cap space when the market is going up. When the market is coming down, mid and small cap fund managers can outperform this. But over a cycle, of course, in India, over a full cycle, there will be almost certainly the active fund managers can outperform the passive in a full cycle. But if you can time as an advisor that, okay, I feel that mid and small cap has become 15% of the overall market cap. Today, if you look at the market cap of India, 430 lakh crore, almost 40% is mid and small cap, which is extremely high. But if it comes down to 15 to 20, which normally in the bottom of the cycle it comes, then your passive mid and small cap funds can actually be, in the index funds, can be a very good tool for you to create alpha. And in that case, if you're generating that much alpha, then paying tax would not be an issue, firstly. Secondly, if you're too worried about tax, of course, and that's what we thought earlier, balance advantage fund as a category on the active side was born out of the fact that you don't need to keep churning and creating tax incidences for you. That got extended in thematic advantage fund of fund for sectoral investing on the active side. And on the passive side also, you will have fund of funds. You already have a passive equity fund of fund, which is doing that. But there, the role of changing and churning the underlying ETF, you are actually giving it in the hands of the manufacturer. If you want to put your own IQ and your own changes, then that will not work. But otherwise, there are passive fund of funds also available, which you can utilize to create long-term alpha by allowing the fund manager to make the changes within. So it is not a static decision that, okay, I pick the 500 universe and I'm done. The fund managers can create alpha, which is what we've done also successfully in the last 5-6 years. And that can be looked at. The universe is quite big, and for all of you, I think the fund of fund universe, both on the active and passive side, is also something which you can learn deeper. I know it's a topic which I can speak for 1 hour, but I'll hold my thoughts over here. Fund of fund, great tool for advisors to make alpha. You just need to know who is doing what, and of course you have to bet on the right fund manager, whether it's active, passive, doesn't matter. And as far as the cycle is concerned, within large cap, generally in a trending upward market, the large cap active fund manager may find it difficult versus the mid and small cap passives. But on the reverse, of course, large cap does well. I would say that...
I'm assuming you've studied this over the last, there's some kind of study that has been done. And you've seen that even in rallying markets, I personally never thought that passives in small caps would do better than managed funds.
They do. Because, I mean, when the tide turns, everything goes up. And as an active fund manager, you're not necessarily able to pick up everything. And because India has so many sectors, randomly sometimes chemicals, like for example, metals. How many people were able to actually catch the metals rally? Those who caught the metals rally, and you can check actually the PMS performances also, those who caught the metals rally have been able to do well. Those who were stuck with the traditional way of investing probably ended up in pain in the last 1.5 years. And it's for us to see.
Okay, so this is my last question to both of you before we have a rapid round, okay? You both have both active and passive in your AMC. Now they're like, having 2 children. You love them both equally, but they are also vying for the same resources. So andar jhagda hota hai for resources. Is that something that happens?
Not at all. No jhagda. I mean, they are, and it's actually a very good analogy you gave. I have a daughter who's 21, I have a son who's 18. One's an absolute extrovert. She got back this morning at 7 a.m. from a 2 days concert in Bangalore. First day crowd was 7,000, second day crowd was 10,000. She absolutely loved it. Meet my son, he wants to be a pilot. Why? Because in the cockpit there will be only 2 people and not many more to be dealing with. So different people, same house, same parents. Whenever each one asks me, who do you love more? I say, you are my most favorite son and you are my most loved daughter. And that's just the way it works. See, as a manufacturer, firstly, it's about positioning what is it that your core belief is. And if I am a believer that I want to be a manufacturer at scale, then it's never a question of or, but it's a question of and. So I will have a 200 basis points actively managed product and a 10 basis points overnight fund. Even that is a choice by itself, okay? So within that, it's equity, hybrid, fixed income, cash, within equity, passives, active, all of it. The last point I'll make on the subject is, if you put the customer at the epicenter and are clear about the positioning you want to occupy as a mass manufacturer, then you will keep producing products and partner with people like yourself to choose what's right for the customer, or give him the option to come and choose whichever he wishes to partake from. But that's the way we look at it. There is enough resources available to provide the customer the option and you the choice of being able to bundle it for them.
Is that how you also have it in your organization?
So just to quickly answer that question, if we were in a country where the pie is finite, then obviously this question is one is eating the other, which is what is happening in US. Of course, in US it's happening because of taxation also, where ETFs have a definitely beneficial taxation. But there obviously one is shifting to the other. In India, the pie itself is increasing from when I joined the industry itself, the industry was 2 lakh crores, today it is 80 lakh crores. Passive is also increasing, active is also increasing. And still, neither are active and passive within iPro fighting, neither is a UTI and an ICICI, vying for the same. We are all working together and growing together. So we have the best of relations with all the AMCs because it's the pie which is growing. And India grows, we grow. So I don't think there is any active passive. Yes, in terms of interaction, in terms of growth, there has been a lot of focus that some AMCs have put on the passive side, and they are basically reaping the benefits of that in terms of the wider bouquet. But I don't think there is any doubt that both are going to grow. And that's why there is no fight within. Thank you.
Yeah, but the relationship managers, दोनों के अलग-अलग आते हैं हमारे पास.
Yeah, because one will not sell the other, right? So.
And they buy for our pie, by the way. So, rapid fire के लिए ready? Ben, starting with you. For a 25-year SIP investor, 25 years old, passive core or active core? One word answer.
Well, if it's only one word, then passive, because the longer the time horizon, I think the benefits of passive are the greater due to compounding.
Chintan.
I'm in a passive conference, so I'll say passive, but then I'll go by what Warren Buffett also said that, right? I have the 500 stock universe and you'll be fine. So, passive.
What about you?
Just one word, one fund, then it will be a passive.
Wow. One segment where you believe active will always win over passive in India. When?
Well,
You can't copy answers, all of you. So.
I can only speak probabilistically, but just based both on intuition in terms of which segment is most under-researched, plus also the evidence from our research, it's probably small caps or mid and small caps.
I don't think in India anything is constant, so there will be no answer to this. No ways.
I'll stick with my answer from earlier, small cap.
Okay. If your own family asked you for just one passive product category to hold for 20 years, what would you pick?
Nifty 500. Give it all.
Wow. Chintan?
Yeah, and I'm sure there will be an option of multi-asset passive in what form, where you have all the asset classes within one bouquet of fund of fund. That would be it.
So multi-asset
Multi-asset passive fund.
Passive fund. What about you, Ben?
Probably the S&P World. That's a globally diversified index, and I think it's very hard to pick a single. Not only stock picking is hard, but on the long run, maybe even country.
So S&P
cross-country diversification is also important.
I would do that. It's a nice fund. So one thing distributors and RIAs should stop doing when recommending passive funds.
Churning.
We don't choose.
One thing they should stop doing. I don't know. No clear answer. No clear answer.
Ben?
I don't know what do now, so it's hard to say
wouldn't know what we should do
stop.
from tomorrow, so that when we are advising passives, what do we do from tomorrow to make it better? That was the next question.
Sorry, could you repeat?
What should distributors start doing from tomorrow to use passives better?
So that's a good question. Probably explain the benefits of buying the haystack rather than needles.
I think Pessi is the only one who's come prepared.
No, I think start doing, sorry.
No,
Did I jump the queue?
No,
Please go
no,
ahead.
I mean, it's okay. You can speak, then I can speak. That's okay. So I was just saying that he mentioned very fondly of private bank as one of the options, right? I'm very happy that I launched it many years back. And in that sense, from a advisor perspective, at least know what is available. So not just private bank, even the non-bank NBFC, right? No, non-bank financial services also available. So if I'm assuming all of you all have done detailed work, etc., but know whatever is available and put a lot of thought on what can do well in the near future rather than getting sucked up into what is in momentum. So the two answers which I can think of now is, one is don't go by momentum of the past and try and put in the, which most of you all may not be doing already. But what you should do is know what is available today. Like say oil and gas and FMCG would be two favorites right now. So I don't know how many of you all know, but there is an FMCG ETF, there is an oil and gas ETF. Not because both I will launch, but they are there for you to choose from. Thank you.
Okay. But there are like I don't know, thousands of ETFs. Chintan, kaise? I mean, even for us.
No, there are only 250 in India.
Only 250.
There are only 250 in India, out of which probably 50 are all large cap. But in terms of sectors and segments, there are limited that you can choose from. So it's not thousands.
Okay, so there's homework for us to do. Okay, if TERS were the same, would you personally pick an active large cap or a Nifty 50 index?
If TR is the same.
TR is the same. Wow, all are thinking. This is a rapid fire.
So I'd pick a passive for the simple reason that, passives bring, a very different set of behaviors from human beings than actives do. The fact that I'm investing is clear then that I want to be invested. And the variation in performance leads to bad behavior, not just overall volatility. So if expectation is to remain invested, large cap, the tendency to misbehave as an investor is larger when I see variation in performance other than the volatility that the market demonstrates. That's why passives.
What about you, Chintan?
I think I'll go with active large cap.
And why is that?
Because in India, courtesy the breadth of sectors and segments which are coming up, a large cap fund manager will have that much better choice to outperform. And if he has to not fight for that 1.5%, 2% extra, then it becomes easier to probably generate the alpha. So if TRs are same, then I think active has a better chance.
Ben?
Even though you were asking about the competitors index rather than ours, I would still go the passive.
Okay.
To really
What is the biggest myth about passive that you like the audience to permanently delete from their memories?
I think the biggest myth that people have when you talk passives to them is that, oh, with a passive, I'm going to be settling for the average.
That's true. That's true. Yes.
That's what we need to shatter. You're doing just fine. You're doing just great. A 10,000 rupee SIP in our Nifty 50 index fund since 25 years back that we launched it. You'd have invested something like about 31 lakhs. Your value today is 2.42 crores. What's the debate? How did you become inferior in this? How was this, you're settling for the average? I think that's the biggest myth, that passive means eh.
Yeah, thanks. I agree with that.
And one more would be probably lowest cost is not necessarily the best fund to choose from. So if you compare, like say 5 funds and you say, okay, this is the lowest cost, assuming there's not much big difference, necessarily lowest cost is not the best fund in terms of how it is run. So you need
what else do we look at?
I think everything gets taken care of in tracking error. So if you look at one is of course liquidity on the exchanges, but Their market makers provide for most of us, so it's fine, but liquidity is important. But tracking error is also something which one should look at, because there, how efficiently the fund is managed would also make a very big difference in terms of your outcome. It's not just the lowest cost producer who should be taken blindly.
Ben.
Yeah, I would refer back to one of your earlier questions, which I didn't get to answer at the time, but I think it's a very common misconception about passives that as they grow, they distort the markets or distort the price signals. And I think an important point there is that price discovery happens not by holding assets, but by trading. Like the information in markets gets disseminated by trading activity. And just in the US, if you take the US statistics, the average holding period of a stock is less than a year, but the annual churn of the S&P 500 is just 4%. So if you just think about, like, in an extreme case, if 80% of assets is passive, 20 is active, it would still mean that 3% of the annual AUM is churned by passives, but about 20% is traded by active, even though they are only a fifth of the market. So I think one common misconception is this price distortion of passive, which, because the majority of trading activity is still done by active, even if their share of AUM in an extreme case very tiny, that would counter that, that proposition. And even just if you look at recent evidence, again, from the S&P 500, price discovery is still happening. The S&P 500 is only down 3-4% from the all-time highs, but all the top 10 constituents are down 20% plus. For example, like Microsoft, Tesla, Alphabet. If you look at the top names, they are massively down, even though the index is resilient. So basically, it's just it's an anecdotal evidence of the theoretical argument that I just exposed, that I think because actives are trading much more actively, they can still disseminate the information that's coming into the market in real time.
Okay. So, one last question. If passive investing reaches 40% of the Indian market, what is the one unintended consequence regulators and investors are not thinking about today?
I think it's back to the same point, this price distortion that happens with a lot of money chasing, because I would still like to believe that a very large, even at 40%, will be around the large cap market, which is where it is even today. And this temporary distortion of prices that happens would be an unintended consequence. In the short term, at least, that I would believe will be a challenge for the market here.
So I think the institutional part of the money will probably go towards the large cap. I don't think that's changing that easily. But the non-institutional part, through education, through the help of all the esteemed members here, if we can move a lot more towards the other part of the passives in picking and choosing, then that worry of a concentration in a few segment leading to distortion in the markets would not be a worry. At 40, honestly, it's not going to be a worry, but still, if you feel that it's going to be a worry, let's work towards diversifying it. We've created so many funds, make the most of it.
Ben, you did answer that in your last comment also, but specifically from the Indian perspective, do you think that, if Indian markets come to a place where we have 40% of the assets under management in passives, will there be any unintended consequences?
Well, one consequence that I think SEBI or regulators should be mindful of is that I think with the coming of, or with the proliferation of ETFs, there have been a very powerful trading tool handed to everyone, to retail investors as well, and just echoing the importance of education, basically, without democratizing trading and access to markets without proper education could be something that can have dangers because it's so easy to trade intraday, very liquid, low cost. It's important that all the user base either have access to good advice via ARIA members. Or
so you think the base will increase if it goes to 40%? Okay.
Just one last 30 seconds. If you look at the Indian market context today, the top 10 names are only 51% of the overall market, which generally used to be 65. So even though in the last 3-4 years we've seen concentration of money towards obviously the large cap and ETFs have become big, it has not necessarily led to the significant consolidation at the top. It's actually led to diversification. And second, India still, in terms of, if you look at the top 3 names in terms of weightage, would be 12%, 10%, 8% odd. If you were in Taiwan, it's 56% or 60% one company. If you were in Korea, it is, I think, about 50% in the top 2 companies. So there is obviously a worry if you are concentrated. In India, if you look at it, the top 10 is only 50%. So we are okay, we're fine. Don't worry. Thank you.
Okay, last question. If I had to ask all 3 of you your retirement corpus, what would be the break between active and passive?
So mine's about, I think, somewhere around 65 active, 35 passive. That's because I started investing many years back, many moons back, and passive options within passives have only more recently come. Yeah. So I've been, actually using a lot of passives now, rather incrementally. I think only other than my old SIPs, which continue, everything else just goes into passives.
Chintan, you?
Yeah, so you tell me the active fund manager and I'll tell you the percentage, but nevertheless, I think it will,
it's your retirement,
it will be my retirement, so I assume that I will manage the money on the active side and the passive side would be about 35% in the 500 stock universe. Yeah, thank you.
What about you, Ben?
Yeah, for me, it's about 80-20 in favor of passive, and the active ones are hard to access asset classes like infrastructure, private. Okay,
lovely, lovely, lovely. Please give it up for all the panelists, please. Time is, so we don't have questions for the audience, but can I ask the audience some questions? Does time permit? Oh, all right. Okay. Then we will thank our panelists. Thank you so much. It was so lovely to hear your views. Pleasure.